Have you considered trading the Crash 500 index using the Fibonacci Retracements? Hello and welcome to GITIXONE trading channel, where I share tips and tricks on how to trade forex like a pro. In this video, I'm about to show you a secret that will revolutionize the way you trade and the results you get. The Fibonacci Retracement has become a high-end profitable tool used by many great technical traders in history. And today, I will show you how to use the Fibonacci Retracement to trade Crash 500 index profitably. But before we get into that, make sure you hit the subscribe button and the bell icon to get notified whenever I upload a new video. If you find this video helpful, please give it a thumbs up and leave a comment below. I'd love to hear from you. Previously, I had shown you how to use the Fibonacci Retracement tool and how to combine it with the concept of fair value gap. If you have not watched that video, please do so, as some of the vital information required for understanding this video are already mentioned there. Today, let's see how to use the Fibonacci Retracement to trade Crash 500 index. This is a chart of Crash 500 index. I'm going to take this tutorial slowly from here. As you can see, the market was going down on a downtrend from this level, and then it got to a key level here at the bottom, and the market started to bounce up from that level. Now, as someone who wants to use the Fibonacci Retracement tool, you will take the Fibonacci tool here and then you will draw it from the top and then you drag it to the bottom here, and you can extend it over here so you can see the lines properly. Alright, so you see that the market actually returned back to the 0.5 level, which is the 50% level. And in our previous video, I'd already mentioned that this is one of the three most important levels that you should pay attention to while using the Fibonacci Retracement tool. Alright, so the market have returned back to this 0.5 level or the 50% level. And what happened? The market dropped down from that level. Now let's quickly observe what is at that level that caused the market to drop down. Because the Fibonacci tool cannot be used in isolation, or should not be used in isolation. It must tally with some other price action, which I'd already mentioned in a previous video. So having drawn this box, let me delete the tool so you can see the chart clearly. Alright, I'll zoom also for you to see. Okay, so now the market had returned back into this level here. What is at this level here? We'd observe that this market has been dropping down without an opposite candle. Hence, there is a large imbalance and a lot of fair value gaps in this region. So the market has created a lot of imbalances and fair value gaps. That is why the market was seeking to go back to this price level. But then there is something that is inside this level that you cannot see now until I go to a lower time frame. So I'll be going to a lower time frame and I'll show to you what is in that particular place that the market saw and made it to go down. Alright, you can see at the 15 minutes time frame that the market had returned back into an order block. This is a kind of order block I'd already mentioned before in one of my recent videos. Alright, then if you are not a kind of trader that trades with the order blocks or imbalances or fair value gap, because there is a fair value gap or what you can call an imbalance in this round, but there's a fair value gap between this and this. Remember I mentioned that the fair value gap occurs after a drop like this, after 3 candles are formed, and you see that between this third candle and this first candle, which is a bullish candle, there is a gap. Alright, so that is what the market saw. The market sought for this order block that led to the creation of a fair value gap, and that is why the market actually tumbled down from there. That is one of the confirmation. Then I'm going to return back to the 1 hour time frame so you will see something else. Alright, on the 1 hour time frame, you will see that the market actually created an inverted hammer here, and that is also one of the confirmation I showed to you in my previous video that you will see that will make you to follow the Fibonacci retracement tool. So there are two confirmations here. Number one, the market was going down, so we know that it will continue to go down. Number two, it created imbalances and fair value gaps. Then we needed to look at the place where there is an order block, and the order block then leads to a fair value gap. And I showed it to you on the 15 minutes time frame that there was an order block in this area and that there is a fair value gap immediately after the order block. Let me tell you a secret. Once you see a fair value gap formed immediately after an order block, it is a very, very important area to pay attention to for markets to react. All right, so the market actually started selling down from the 50% level, which is a 0.5 level, and we can see that it's a level that is a confluence with an order block and fair value gap. We can see that the market sold from this level massively, and our take profit would have been hit based on how I told you in our last video that you had to set your take profit. Let me show that to you also. From here, we started to draw the Fibonacci tool in this manner, and then the market got here. So should we be selling from this level? We're going to be taking our profit at the 0 level or below it. That means if I'm here to enter this trade at this level, I will be targeting from here to this 0 level. And the market actually hit it and went past it. So our take profit was hit. Now let's look at other trade. We can also see that this is the same chart of the Crash 500 index. And you can actually narrow this down to any time frame. But then let's just look at this same one. As the market was going back up, it took out this high that was here. So there was a little shift in market structure. And I'll show that to you also in this channel, how you can trade shift in market structure. Now we are going to apply the Fibonacci tool to this level upwards, expecting market to return back. I will consider the market return back to the 0.618, which is the 61.8 level, before going back up again. This is also a key level that I had already mentioned to you previously in my video. All right, so if we are to also explore why the market decided to buy from that level, we're also going to find the reasons there. Number one, we can see that there is a sort of price action at this level here. So we'll go to a lower time frame and find out what happened. But before that, let me delete this Fibonacci tool so we can see it clearly. Let me also delete this one. All right, so now let's go to a lower time frame, such as the 15 minutes time frame. Okay, we are here at the 15 minutes time frame. Now you can see that there was a price action at this level. This is a mitigation block. All right, so this is responsible for the move in this particular market. The market decided to buy from this level because of the mitigation block that was here. All right, but then if Fibonacci 2 had already told us that I am also going to buy, why is at a key level, which is the 0.618 level. The 0.618 level, the 0.5 level, and the 0.382 level are the three most important levels I showed to you previously that you can use to enter a trade. So these are some other reasons why this trade became valid. All right, so this market was going to buy. Now let me show you the last scenario with the same tool, Fibonacci tool, and how to combine it with price action to trade the Crash 500 index. Let's go back to the 1 hour time frame again. All right, you can see this is also another price action that just occurred here. Let me show this to you. From here to this level is a swing. All right, so you extend it in this manner. Let's go to a lower time frame so I can show to you that the market actually bought from the 0.5 level again. So let's go to a lower time frame. As you can see, this is the 15 minutes time frame. The market was buying, creating structures of higher highs and higher lows, showing us that there is a shift in structure upwards. And then it decided to return back. Now what do we see? The market returned back to an order block here, which led to the creation of a fair value gap. And then let me remove this. Let me draw this box for you before I remove the Fibonacci tool. I'll draw this for you. Okay, that's the order block. Then let me remove the tool so you can see clearly. Okay, now you can see that the market actually returned back into an order block that was created while the market was going up. But how did we know? Because of the Fibonacci tool, we know that it will come to the 0.5 level or 0.618, and then we must see something there. So this is a confirmation that make us to say and this market is going to go upwards. Do you understand? So this is how to trade the Crash 500 index with the Fibonacci tool. And you can keep on doing this for so many swings, whether you're on the 15 minutes time frame, or you're on the 5 minutes, or you're on the 1 hour, or you're on the daily, whatever time frame you are on, this holds sway. Fibonacci levels 0.382, 0.5, 0.618 are very important levels at which you should be looking at price actions happening. All right. So let me also show you another trade on the 1 hour time frame before we close this particular tutorial. All right, this is the 1 hour time frame, the same Crash 500 index. All right, so let's look at this. The market started buying all the way from this level, and then it bought all to this level. Now, what do we see? The market returned to the 0.5 level before buying upward again. And you can also go to the lower time frame and you'll find reasons why this market actually bought from the 0.5 level. So the Fibonacci tool is a great tool, and you should be looking forward to practicing this, backtesting this on all of your assets that you trade. This does not only work on Crash 500 index, but in another video, I'm going to show you how to use this same tool on the other indices that are on the reef. But let me also show you particular indices now so that you will just confirm that it's not only Crash 500. Let's look at the V75 index, the volatility 75 1S index. Let me just show that to you as an example. Now look at this. This market had been going up. Let's take this as an example. Fibonacci tool, I'm going to drag it from this level, because this is a whole swing up to this level. All right, so you can see that for this swing, the market returned back to half, which is, it returned back to the 0.618 level. And we can already see the reasons why that level is holding. It's a mitigation block there, and there is an order block at this level. So that is the reason why that market bought from here to this level. All right, so there are many ways to actually use the Fibonacci tool with different assets on the reef, but I just intended to show to you how to use it to trade Crash 500 index. I believe that you've learned a lot from this video and you've got so much value. If you want to learn more, please subscribe to this channel if you have not, and watch my other videos that I've talked about Fibonacci tool and feather lookup. Subsequently, I'm still going to do other videos on feather lookup, explaining it in details so you can understand better. Till I meet you again, happy trading.